I guess quickly moving on. When I was requested to come and talk to auditors and accountants around AML, I was shocked. This is me, my emoji. I said, boss, compliance, AML, tax, talking to auditors and accounting, fairly daunting task. You guys already know, you practice it. What am I going to talk about? So this is what I feel. So please bear with me for my inadequacies as we go along. One of the questions which came about as part of the conversation is why, is there a linkage in the first place? Why do we need to talk about AML, right? And this is taxation or corporate tax or VAT, and what is the connection? So the intent is to try and demonstrate some of the connections which haven't come about as recent as 2020 or as recent as 2018. These are connections which have been there. So that's the intent, to kind of take you through that journey from a high level point of view. But before we go there, let's understand what money laundering is fundamentally. It is the disguising of illegal proceeds. Simple. It's not too complicated. So whether it is VAT, whether it is corporate tax, whether it is anything else, if you generate an illegal proceed by not following what the law requires you to follow, agnostic of whether it is corporate tax, VAT or anything else, you are generating illegal proceed. And if you have generated that illegal proceed, how do you bring it into the economy for your use in BAU? That is the process of money laundering, right? And the process of generating that illegal proceed is called predicate crime or predicate offense. So as long as we are following the law, we are not generating any illegal proceeds, and as a consequence of this topic becomes irrelevant for most of us here. Moving on. Interestingly, this is to provide a background in terms of the international initiatives which have been there. So there are 4 pointers here, and Rajiv has spoken on a few of these, but just to kind of give you a sense of what it is. So we talk of FATF. What is FATF? FATF came about as an initiative from G7 countries. From a FATF point of view, FATF came about as an initiative of G7 countries, and it is a premier organization. It's an intergovernmental organization. It's a premier organization which looks at financial crime compliance. And I use the word financial crime compliance because earlier it was money laundering, and the essence, if you look at historically what money laundering was and how it came about, was very different. But now it looks at financial crime compliance, and there is a whole bouquet of things that come under financial crime compliance. So FATF in 2012 brought into its own list of predicate crimes, the thing that they highlighted there was tax evasion. So if you look at the list of predicate crimes, it's all listed here. The ones which have been highlighted specifically are around tax evasion, smuggling, excise duties, customs, direct and indirect taxes. So it came about in their focus. Another interesting aspect of things that they have brought in 2001, after the Twin Towers were brought down, that is when FATF started looking at terrorist financing. Before that, terrorist financing was not on the FATF agenda. FATF was requested to start focusing on terrorist financing as a consequence of the Twin Towers coming down. So that is FATF, and point number 1 in terms of where tax evasion or what is the interlinkage and how it kind of plows in. Point number 2 is, if you look at the International Monetary Fund, right, in 2017, the then managing director of IMF, Christine Lagarde, said that tax evasion has now been listed as the top 3 priorities as part of IMF is concerned. So you've got FATF, probably that was one institute which only looks at money laundering or anti-money laundering and how to tackle money laundering. So, that was one aspect of it. Then you have IMF, which is talking about it and has included it as part of their agenda, right? Point number 3, tackling tax evasion is a key G20 objective. People from India would know that India, who's holding the presidency of G20 as we speak, it is a key G20 initiative. And what I have quoted here is basically the Secretary General's report to G20 leaders, and this is the OECD secretary, and key words have been highlighted in the statement that was made on the initiative and what was enabled as part of this. Fundamentally, come up the key things. Fixing the international tax system of loopholes. That was one of the key things that OECD took upon itself and tried to plug it, right? Fight against tax avoidance and tax evasion. That was one of their key pillars that they were looking at driving. That's one. Implementation of CRS, Common Reporting Standards. So a lot of people ask this question, does it get reported? Do intergovernment organizations or entities have information or data? Well, I'm doing it in my silo here. How will they ever find out? Point number, important to understand, automatic exchange of financial and accounting information. Nobody needs permission. These are all being tied up at a global platform, at a global level. It does not need permission or authorization from the individuals to share data. So that's where the data is moving. And of course, BEPS, as you heard about it, of course I'm not going to speak about it, but base erosion profit shifting is a concept that, of course, accountants are very familiar with, but that's one of the things. Fundamentally, as part of BEPS, again, what was the key things? Realigning taxation with the substance of economic activity, that was one of the key things. Improving transparency, that's another key aspect of something that we do as part of BEPS and economic substance review now. Last but not the least, tackling tax evasion is a United Nations sustainability goal. So if you look at the pillars in terms of people who are working around the globe, or institutions or organizations which are working around the globe to plug this, you have heard FATF, you've heard IMF coming in, you've heard G20 playing a clear role with organizations in their purview coming in, and now you see United Nations. It is also part of the UN sustainability agenda to ensure that they are able to plug these things. So that is just to give you a perspective and flavor of how things are working globally. And these have been there for quite some time. These are not new developments that we see. Coming down to UAE, how does it augur for UAE? What is it that we have to do in UAE, or what's happening in UAE? So we've all heard about these aspects in terms of what? The intent was to show, well, these are the set of people or professionals who are called as gatekeepers, right? You have financial institutions, and they have been covered and part of the system for a very long time. The rest of them are known as DNFBBs, right? So while we've stated here the 2018 law, which is the federal law which deals with AML, but it is not fair to say that it all started in 2018. AML for FIs was applicable even before that. In 2018, they refreshed the law, and through the cabinet decision in 2019, they brought the segment of DNFBBs under the law, which have been covered in other global geographies. So from a UAE point of view, what was relevant as part of 2018 and 2019 was that DNFBBs were brought under this umbrella. That's the critical bit which happened at that point in time. Why are DNFBBs important? I mean, why the focus, and why the entire focus for the last 24 months in this segment? Fundamentally, they are seen as professionals who can either facilitate or stop the generation of illegal proceeds and thereof. So that's the core bit, and that's why the focus set, and that includes financial institutions as well. However, they have a very well structured and beaten up process over the years. So in terms of focus, while DNFBBs, that's why the focus is. What is the expectation from DNFBBs? Try to identify, do due diligence, raise suspicion if you're suspicious about it, and keep records. Very simple. Couple of things that are expectations from that point of view. So as we go out and we deal with financial matters, then of course we handle a lot of clients and we have that information. The expectation then squarely falls on our shoulders as DNFBBs. That's the critical bit. Violation may subject to, of course, penalties and sanctions. So That's a known element. Oh, it's a difficult one. I obviously didn't want to preach to accountants what tax planning, tax avoidance, or tax advice is. So that wasn't my intent, and hence I have very happily quoted exactly from where these definitions have come from. So that's there. But it is important to understand, the first section is important to understand. The first section on tax planning, tax avoidance, and tax evasion, those definitions are coming out from where? They are coming out, I have taken them from the Woolsberg group on guidance on customer tax evasion. What is the Woolsberg group? Is anybody aware what is the Woolsberg group? It's a group of 13 banks, international banks, who look at money laundering and financial crime as a concern, and they help draft and formulate policies and procedures and guidance to deal with it for financial institutions. It is a group which has a lot of credence and is valued internationally, and you will have them making recommendations to FATF as well. Critically, it is important to look at one aspect. While we understand what planning, avoidance, and evasion is, there is a risk of facilitation of evasion. And that's the last bit if you look at. Evasion, facilitation, risk. And I'm just taking a moment to point that out is, as of now, evasion, facilitation is not a predicate crime or an offense as far as FATF is concerned. However, as far as Woolsberg is concerned, they have made a recommendation that it should be considered. So when financial institutions look at it, they will always use that as a lens. So again, as of now, it is not a predicate crime, but it is something that is under the scanner or lens, how people look at evasion and people who are facilitating that. So from that point of view. The critical aspects in terms of what is tax advice and how do criminals use tax advice is listed. I don't think we need to kind of get into each of it, but the intent, of course, was to highlight what criminals can do in terms of misusing professional advice. We may not be aware, but we may be playing into their hands. The intent of highlighting it here was to demonstrate, look, these are the things that you have to be cautious about. When you hear advice being sought in terms of how to structure or create obscurity, of course, there is a larger purpose to it. And that is something which is food for thought. I am not going to sit on moral grounds here to opine right or wrong. That's not the intent. But I'm saying that's food for thought. Think about it. If somebody is giving that indication, what is it that we are wanting to get to? What is it that the other person is wanting to do? So that's there. Quickly moving on in terms of giving some examples, fundamentally. So this is around how money laundering happens, and if these are the 4 stages. Fundamentally, we are aware, basics of money laundering or is these 3 stages, which is placement, layering, and integration. This is just an example in terms of how one can facilitate. So if you generate, let's say you have a criminal who's generating money from crime, and how does he bring it back into the system? The first stage is you could use it, and this is an example which is through a usage of credit card and debit card. But fundamentally, the criminal would get to introduce that money into a domestic bank account. So that's stage 1, right? You introduce it. And that's called placement at that stage, because you're introducing money into the financial system. So that's stage 1. But you want to use it and take it into another jurisdiction. And if you were to take it and do a wire transfer, there is far more scrutiny and questions being asked around it, so you are not able to do it. So hence you kind of bring out this entire circle. From once you've managed to get into the domestic account, it's got some level of, you've crossed the first hurdle. because there is fair amount of questioning where you introduce money into a bank account, and if it's large sum of money. Of course, the first stage can also be split into multiple. So it's not as if a criminal will walk into with loads of money and that. You could split it into 50 transactions and with small money. But point taken is that once the money has been aggregated here, the second stage as part of the layering process. The layering process is basically the process through which you are trying to disguise the origin of funds. So you introduce this money here after doing multiple transactions here, and then you move it to an offshore bank account as part of the layering process. Now when you've introduced this as part of the offshore bank account, as a second stage, you could have cash withdrawals from there if the money has to be used in the offshore jurisdiction. However, if you want to take it to another jurisdiction which has far stringent controls and you do not have any regulatory arbitrage in those jurisdictions, you may then want to move it into another bank within the offshore setup, a bank which offers credit card facilities or debit card facilities. And then you will have multiple users who will take loads of these stacks of cards. And we all are aware, we would have seen in various interactions, we would have heard of that these cards are then used in some other jurisdiction to take cash straight away. One of the vulnerable segments as part of that are part of the DNFEBs. You will have people who deal in precious metal. Their counters do randomly get used for this purpose as well. Anybody with a POS machine can be negotiated on, and this is how cash withdrawal happens in another jurisdiction. Of course, it's an element and a trigger and a red flag for for companies which manage these cards, or with networks which manage these cards as well. So it's a known thing, but then that is how the entire cycle moves. So this is just one example to demonstrate how illicit proceeds could then be brought into the financial setup. So that's one example. The second example is around a different situation where you generate obscurity of ownership. That's one of the other attributes which are there. Obscurity of ownership is one of the UBO not known, or you have structures being created which are held by companies, are held by another company, and you try to layer it multiple times. Typically, from a financial crime point of view, anything more than 3 levels, if you don't understand a warm body or who the ultimate beneficial owner is, it's a complex structure. It becomes immensely difficult. Well, while simplistically we are saying it's one transaction into the other, typically these could be 15, 20 transactions before you get to the core to understand where the source is coming from. Hence it becomes extremely complex, and it's easier. Over a period of time, people will let it pass. Within the financial institution setups as well, this happens. So it's a huge challenge. But if you look at this as an example, what is happening here? The first stage is of illicit source of money coming in. So you have this wealth which has been generated, whether it is from any criminal offense, fundamentally whether it is tax avoidance or it's drug money or anything else, that's come in. What happens? As part of placement, that money is being moved into an offshore bank account. Now if you look at it, between placement and layering, both these companies, you want to use 2 companies, both the companies are owned by the same guy. But people are not aware, because you would have a structure through which the UBO has been placed at a distance, and somebody has not been able to map both of these off. That's point number 1. Point number 2, these are in 2 different jurisdictions. So each jurisdiction may not be aware of that level, may not have that level of understanding. So again, you move it to an offshore bank account here, which is, let's say, company A. Then you have another company, which is a domestic bank account, which is company B. The transaction, as you see, is basically moving money from A to B for buying shares of company B at an inflated price. So the company B shares are not worth as much. However, because it's the same owner, you're inflating the share price and you're moving the money into company B. So effectively, you've demonstrated that you've made a prudent financial transaction in terms of buying shares of a company. Very legitimate. Nobody will get into questioning the transaction. Understandable. But the crux is that this is inflated. Doesn't make a difference because the owner is the same. So that's the stage of layering which has happened. This money then can be paid out as salaries and dividends to the same guy, or salaries to others, dividends to the same guy. And then these monies could again be aggregated and brought in for investing in businesses, in asset classes, multiple ways of then using this and keeping it. So once it reaches the last stage where people use this money to buy various asset classes, then it's kind of integrated, it is available as fairly legit clean money that you can then use. The last couple of slides, just 2 slides to kind of leave you with thoughts in terms of what are the red flags or something that when is it a good time to walk away from these scenarios? Again, not going to be kind of judgmental and say, but then it's important to understand saying these scenarios, if they come about, these indicate something more and should not be taken as face value. Rajiv was speaking of under-invoicing, over-invoicing. It's a clear case which is a red flag, right? A lot of times when we see people proposing structures, trusts, foundations, unless there is substance to what they are requesting, and it makes sense and one is able to, that is the level of prudence that is being expected from professionals. So that's another, that could be indication of larger initiative to launder money. Of course, if you know that a client is under investigation, it's a good time to say, well, we may not want to deal with you, but again, that's another one. A lot of times you would have accountants and professionals who are misled, and the criminals will come and lie. And unless you are able to kind of get through the basic fraud checks or have a basic sense of what you should do in terms of checking that information from a secondary source, you may be kind of led into believing what is being said is true and may get used as part of that activity. These are last couple of things which are there in terms of red flags, which are there for people to consider and keep in mind when you look at it, when you deal with clients, in terms of at least getting into and doing another level of due diligence and understanding what's going on. So I'll leave you with that thought. Rajiv, over to you.